Hey everyone, and welcome back to the channel. Today, we're tackling a big topic that might seem intimidating, but I promise, by the end of this video, you'll feel much more confident about it. We're talking about mortgages. Specifically, how do they work here in the United States? If you've ever dreamed of owning your own home, this video is your essential first step. So, what exactly is a mortgage? At its core, a mortgage is just a loan. But it's a very special type of loan used to buy property, like a house or a condo. Since most of us don't have hundreds of thousands of dollars just sitting in a bank account, we need help to make that big purchase. That's where lenders like banks and credit unions come in. You borrow the money from them, and in return, you promise to pay it back over a set period with interest. Your new home acts as collateral for the loan, which means if you stop making payments, the lender has the right to take the property. It sounds a bit scary, but it's a standard security measure for the lender. The whole process starts long before you even look at houses. The first step is getting pre-approved. This is where you go to a lender and they review your financial situation, your income, your credit score, your debts, and your savings. Based on this, they'll tell you the maximum amount they're willing to lend you. Getting pre-approved is crucial because it shows sellers that you're a serious buyer. It also gives you a realistic budget to work with, so you're not falling in love with homes you can't afford. Now, let's break down the key parts of a mortgage. You'll hear these terms a lot. First is the principal. This is the initial amount of money you borrow. If you're buying a $400,000 house and you make a $100,000 down payment, then there's the loan term. This is the length of time you have to pay back the loan. The most common terms in the US are 15 years and 30 years. A 30-year mortgage will have lower monthly payments, but you'll pay a lot more in interest over time. A 15-year mortgage has higher monthly payments, but you'll own your home outright much faster and save a ton on interest. The choice depends on your financial goals and how much you can comfortably afford each month. When you put these pieces together, principal, interest, and term, you get your monthly payment. But wait, there's a little more to it. Your total monthly housing payment is often referred to as PITI. That stands for principal, interest, taxes, and insurance. Property taxes are what you pay to your local government, and homeowner's insurance protects your home from damage. Usually, the lender will collect a portion of your annual taxes and insurance costs each month and hold it in an account called an escrow account. When those bills are due, the lender pays them for you. It's a convenient way to make sure those important bills are always paid on time. Okay, let's talk about the types of mortgages. The two main categories you'll encounter are fixed rate and adjustable rate mortgages, or a fixed rate mortgage is the most straightforward. Your interest rate is locked in for the entire life of the loan. Whether it's 15 or 30 years, your principal and interest payment will never change. This predictability is great for budgeting and peace of mind. You always know exactly what to expect. An adjustable rate mortgage, or ARM, is a bit different. It typically starts with a lower interest rate for an initial period, say, 5 or 7 years. After that period ends, the interest rate can change or adjust based on the market. It might go up or it might go down. ARMs can be a good option if you plan to sell the house before the initial fixed period is over, but they come with more risk because your monthly payment could increase significantly in the future. There are also different types of loan programs, often backed by the government. You've probably heard of FHL loans, which are insured by the Federal Housing Administration. These are popular with first-time homebuyers because they allow for a lower down payment and are more forgiving with credit scores. Then there are VA loans, which are a fantastic benefit for eligible veterans, active duty service members, and their spouses. VA loans often require no down payment at all. And there are USDA loans for rural areas, which can also offer 100% financing. Each program has its own specific requirements, so it's worth exploring which one you might qualify for. Let's quickly walk through the timeline. You start by getting then you find a real estate agent and start house hunting. Once you find a home you love, you make an offer. If the seller accepts your offer, you go under contract. This is when the real work begins for your lender. You'll officially apply for the mortgage, and the lender will start the underwriting process. This is a deep dive into your finances to confirm you can repay the loan. They'll verify your income, your employment, and your savings. During this time, the lender will also order an appraisal. An appraiser will visit the property to determine its fair market value. The lender needs to make sure the house is worth the amount you're borrowing. You'll also get a home inspection to check for any potential problems with the property, like a leaky roof or a faulty furnace. Assuming everything goes smoothly with underwriting, the appraisal, and the inspection, you'll be cleared to close. Closing day is the final step. This is where you sign a mountain of paperwork. Seriously, your hand might get tired. You'll sign the final loan documents, and the seller will sign the deed over to you. You'll also pay your closing costs, which are fees for services like the appraisal, title search, and attorney fees. Once all the papers are signed and the funds are transferred, you get the keys. Congratulations, you are officially a homeowner. So, to recap the key takeaways, a mortgage is a loan to buy a house. Get pre-approved first to know your budget. Your monthly payment, PD, includes principal, interest, taxes, and insurance. Choose between a predictable fixed-rate mortgage or a potentially riskier adjustable-rate mortgage, and explore government-backed loans like FHA or VA if you qualify. The journey to homeownership can feel long, but taking it one step at a time makes it manageable. The most important thing is to do your research, ask questions, and work with professionals you trust. Like a good lender and a great real estate agent, they are there to guide you through every step of the process. I hope this breakdown made the world of mortgages a little less confusing. It's a huge financial commitment, fixed rate versus adjustable rate mortgages. Which one is the right choice for you in today's market? It's a big decision, and it can save you, or cost you, thousands of dollars over the life of your loan. So, let's break it down together, clear up the confusion, and help you make a smart financial move. A fixed-rate mortgage is pretty straightforward. The interest rate is locked in for the entire term of the loan, whether that's 15, 20, or the common 30 years. Your monthly principal and interest payment will stay exactly the same every single month until the loan is paid off. It's predictable, it's stable, and it's simple. You always know what to expect. On the other hand, we have the adjustable rate mortgage, or ARM. This one's a bit more dynamic. With an ARM, your interest rate can change over time. It typically starts with an initial fixed rate period, which might be 3, 5, 7, or even 10 years. During this time, it acts just like a fixed rate loan. But after that introductory period ends, the interest rate will adjust, usually once a year, based on a specific financial index. This means your monthly payment could go up, or it could go down. So why would anyone choose an ARM if a fixed rate is so stable? The main attraction of an ARM is the initial interest rate. During that introductory fixed period, the rate on an ARM is almost always lower than the rate you'd get on a 30-year fixed mortgage at the same time. This lower rate translates into a lower monthly payment, at least for the first few years. This can make a home more affordable up front and free up cash for other things, like furniture, renovations, or just building your savings. Let's look at a simple example. Imagine you're taking out a $400,000 loan. A 30-year fixed-rate mortgage might be offered at 7%. But here comes the adjustable part, and this is where you need to be careful. It's tied to an index, like the SOFR rate. If that index has gone up, your interest rate will go up. If the index has gone down, you could get lucky and your payment might decrease. The risk is that rates could rise substantially, and your once affordable payment could become a major financial burden. To protect borrowers from extreme jumps, ARMs have something called caps. There are three main types of caps. First, there's an initial adjustment cap, which limits how much the rate can increase the very first time it adjusts. Then, there's a subsequent adjustment cap, which limits how much it can change in the following years. And finally, there's a lifetime cap, which sets a maximum interest rate you'll ever have to pay over the life of the loan. So, who is a fixed-rate mortgage good for? It's the perfect choice for the long-term homeowner. If you see yourself living in this house for 10, 20, or even 30 years, and you value predictability and peace of mind, a fixed-rate mortgage is your best friend. You can budget with certainty, knowing your largest monthly expense won't suddenly jump. It's especially appealing in a lower-rate environment where you can lock in at a great rate for decades. It's the set-it-and-forget-it option of the mortgage world. It's for the buyer who wants to sleep soundly at night, knowing exactly what their payment will be next year and 10 years from now. Now let's flip the coin. When does an ARM make sense? An ARM can be a brilliant financial tool for certain types of buyers. For example, if you know you're not going to be in the house for the long haul, maybe you're in a job that requires you to relocate every few years, or you're buying a starter home with plans to upgrade in 5 to 7 years. In that case, why pay a higher interest rate for 30 years of stability that you'll never use? You can take advantage of the lower initial rate of a 5/1 or 7/1 ARM, save a lot of money, and then sell the house before the rate ever has a chance to adjust upwards. An ARM can also be strategic for buyers who expect their income to increase significantly in the near future. Maybe you're refinishing a medical residency or an advanced degree and anticipate a big jump in salary. You can handle the lower initial payments now, and you'll be in a much stronger financial position to handle potentially higher payments later on. Or, perhaps you're in a high-interest rate environment right now. You could use an ARM to get a lower initial rate, and then refinance into a fixed-rate mortgage in a few years if and when overall interest rates come down. It's a calculated risk, but one that can pay off. So, Let's bring it all back to today's market. What's the better choice right now? This is a tricky one, and it really depends on your personal situation and your outlook on the economy. For the past decade or so, with interest rates at historic lows, the 30-year fixed mortgage was the undisputed king. It made almost no sense to take the risk of an ARM when you could lock in an incredibly low rate for 3 decades. But today, the landscape has changed. Rates have gone up significantly. A fixed rate that might have been 3% a few years ago might be closer to 7% now. In this kind of environment, the gap between fixed rates and the initial ARM rates is much wider, making the upfront savings of an ARM much more tempting. If you believe that interest rates will eventually come back down in the next few years, taking a 5/1 or 7/1 ARM now could be a smart bet. You get a lower payment for several years, and then you have the option to refinance into a lower fixed rate when the market is more favorable. However, the risk is still there. There's no guarantee that rates will go down. If inflation remains stubborn and rates continue to climb, you could find yourself with a much higher payment after the initial period ends. That's why your personal financial stability and your risk tolerance are so important. If the thought of a fluctuating mortgage payment keeps you up at night, or if a potential payment increase would stretch your budget to the breaking point, then the safety and security of a fixed-rate mortgage is probably worth the higher initial cost. It's a premium you pay for peace of mind. Ultimately, the decision between a fixed and an adjustable rate mortgage is U&T about which one is universally better. It's ES about which one is better for you. You need to have an honest conversation with yourself. How long do you realistically plan to stay in this home? What is your comfort level with financial risk? What's your outlook on your future income and the future of the economy? Don't just look at the initial monthly payment. Think about the total cost over the time you plan to own the home. Run the numbers for different scenarios. What happens if rates go up by the maximum cap? Could you still afford the payment? My best advice is to talk to a trusted mortgage professional. A good loan officer won't just try to sell you a product. They will listen to your goals, analyze your financial situation, and walk you through the pros and cons of each option as it applies to you. They can show you detailed comparisons and help you model different interest rate scenarios so you can make a truly informed choice. This is one of the biggest financial decisions of your life, so it pays to do your homework and get expert guidance. To recap, a fixed-rate mortgage offers stability and predictability, making it ideal for long-term homeowners who value security. An adjustable-rate mortgage offers a lower initial rate and payment, making it a great option for short-term owners or those who anticipate an income increase and are comfortable with a bit of risk. In today's high-rate environment, ARMs have become a more attractive option, but they come with the risk of future payment increases. Your choice should align with your personal financial plan, your timeline, and your risk tolerance. You've probably heard you need to save up 20% of a home's price to even think about buying. Well, I'm here to tell you that for most people, that's just not true. Let's break down what you actually need to get a mortgage. So, what is a down payment? Simply put, it's the portion of the home's purchase price that you pay upfront in cash. The rest of the price is covered by your mortgage loan. Think of it as your initial investment in your home. Lenders see it as you having skin in the game, which makes you a less risky borrower. A larger down payment can mean a smaller loan, lower monthly payments, and potentially a better interest rate. Now, let's get to the magic numbers. The 20% down payment rule is famous for a reason. If you put down 20% or more, you avoid something called private mortgage insurance, or PMI. PMI is an extra fee added to your monthly mortgage payment that protects the lender in case you couldn't make your payments. It doesn't benefit you at all, so avoiding it is a great goal. But here's the great news. You have other options. Let's talk about the 3% and 5% down payments. Many conventional loans are available for buyers with good credit who can put down as little as 3% or 5%. On that same $400,000 home, a 3% down payment is just $12,000. And a 5% down payment is $20,000. That's a lot more achievable, right? These low down payment conventional loans, like the Conventional 97 program, are fantastic for first-time buyers. The main catch is that you will have to pay PMI until you've built up 20% equity in your home. But getting into a home sooner and starting to build equity can often outweigh the cost of PMI for a few years, and there are even more options. Government-backed loans are a game changer. An FHA loan, which is insured by the Federal Housing Administration, allows for down payments as low as 3.5%. The credit score requirements for FHA loans are also more flexible, making them a popular choice for buyers who might not qualify for a conventional loan. The trade-off is that you'll have to pay a form of mortgage insurance for the life of the loan in most cases, unless you refinance later. For our veterans, service members, and eligible surviving spouses, there's the VA loan. This is one of the best mortgage products out there because it typically requires no down payment at all. 0. Plus, there's no monthly PMI. If you're eligible, you should absolutely look into a VA loan. Similarly, if you're looking to buy in a designated rural area, you might qualify for a USDA loan. These also require no down payment and are designed to promote homeownership in less populated areas. You'd be surprised what qualifies as rural, so it's worth checking the eligibility map online. So, how do you decide what's right for you? It's a balance. A larger down payment saves you money in the long run through a smaller loan and no PMI, but a smaller down payment gets you into a home faster, allowing you to start building equity and stop paying rent. You need to weigh the cost of PMI against the potential appreciation of your home's value. My best advice is to talk to a qualified mortgage lender. They can review your entire financial picture or income, your credit, your savings, and lay out all the loan programs you qualify for. They'll help you run the numbers and see which down payment strategy makes the most sense for your personal goals. Don't let the 20% myth hold you back from exploring your options. Homeownership might be closer than you think. Have you ever gotten that exciting call? Congratulations. Your loan is approved, only to find out you still can't buy the house. It's a frustrating, confusing, and surprisingly common problem. You did everything right, got the pre-approval, found your dream home, and then, roadblock. First, let's clear up a huge misconception. A pre-approval is not a final approval. Think of it as a conditional green light. The bank is saying, based on what you've told us so far, we're likely to lend you this amount of money if everything checks out. The if is the most important word in that sentence. The real, in-depth underwriting process begins only after you have an accepted offer on a specific property. This is where things can get tricky. One of the biggest deal breakers is a change in your financial situation. Lenders are watching your finances like a hawk from the moment you apply until the day you close. Did you quit your job to start a new business? Did you buy a brand new car on credit? Or maybe you just maxed out a credit card for new furniture for the house you don't even own yet. Any of these actions can send a massive red flag to your lender. A significant change in your debt-to-income ratio, or DTI, can instantly disqualify you. The lender approved you based on a snapshot of your finances. If you change that picture, they can, and often will, change their mind. The golden rule is, freeze your finances. Don't make any large purchases. Don't open new lines of credit, don't close old accounts. And definitely don't change jobs without talking to your loan officer first. Your financial life needs to be as boring as possible during this period. Next up, let's talk about the property itself. The bank isn't just lending money to you, they're investing in the property. They need to be sure it's a good investment. This is where the appraisal comes in. An appraiser will assess the home's value to ensure it's worth at least the amount you're reborrowing. If the appraisal comes in low-manning, the house is valued for less than your offer price you've got a problem. The bank will only lend up to the appraised value. For example, if you offered $500,000, but the appraisal is only $480,000, there's a $20,000 gap. You'll have to either negotiate with the seller to lower the price, come up with that $20,000 in cash, or walk away from the deal. In a hot market where bidding wars are common, low appraisals can crush a lot of deals. Beyond the appraisal, the property inspection can also uncover issues that torpedo a loan. While a home inspection is primarily for your benefit, certain problems can be deal breakers for the lender, especially with government-backed loans like FHA or VA loans. These loans have stricter minimum property standards. We're talking about things like a leaky roof, major structural problems, unsafe electrical systems, or peeling lead-based paint. If the inspection reveals these types of issues, the lender might require the repairs to be completed before closing. The seller might refuse to pay for them, and you might not have the cash, creating a stalemate that kills the deal. The property must be deemed safe, sound, and sanitary for the loan to go through. Another hidden hurdle is the title search. A title company will research the property's history to make sure the seller has the legal right to sell it to you and that there are no other claims on the property. These claims are called liens or encumbrances. It could be an unpaid property tax bill from a previous owner, a contractor who has never paid for a renovation, or even a claim from a surprise heir. If the title isn't clear, the lender won't approve the loan because they can't be sure their investment is secure. While most title issues can be resolved, it can take time and money, and sometimes they are simply too complex to fix before the closing deadline, forcing the deal to collapse. Let's not forget about documentation issues. The underwriting process is a paper chase marathon. The lender will ask for bank statements, pay stubs, tax returns, and letters of explanation for any unusual deposits or withdrawals. Sometimes, buyers can't produce the required documents in time. For example, if part of your down payment is a gift from a relative, You'll need a formal gift letter and proof of the funds from the donor's account. If you're self-employed, the documentation requirements are even more extensive. Any delay or inconsistency in your paperwork can bring the entire process to a screeching halt. The underwriter's job is to verify everything, and if they can't, they won't sign off on the loan. Then there's the final verification of employment. Right before closing, often on the very day, the lender will call your employer one last time to confirm that you are still employed and your income has you untinged. If you've been laid off, furloughed, or even just had your hours reduced, that can be an instant loan denial, even at the closing table. It's a brutal reality, but it happens. This reinforces the point about not making any career changes during this critical period. So, how do you navigate this minefield and ensure your approved loan actually turns into a new home? First, communication is key. Stay in constant contact with your loan officer and real estate agent. If anything in your financial life is about to change, ask them first. Second, get a fully underwritten pre-approval if possible. This is a much more thorough process upfront, where an underwriter reviews all your financial documents before you even make an offer. It's stronger than a standard pre-approval and can uncover potential issues early on. Third, be prepared for the appraisal. Your real estate agent should provide the appraiser with comparable sales that support your offer price. If it still comes in low, be ready to negotiate or have extra cash reserves. Fourth, keep a meticulous paper trail for all your funds, especially for your down payment. Finally, and I can't say this enough, don't touch your credit. No new loans, no big purchases, no late payments. Be patient and disciplined until the keys are in your hand. Buying a home is a complex process, but knowing about these potential roadblocks can make all the difference. It's not just about getting the loan approved. It's about getting that loan to the finish line. By being prepared, proactive, and financially disciplined, you can turn that loan-approved call into a welcome home reality. The headlines are screaming about unaffordable mortgages and a cooling housing market. But what if I told you that for smart, prepared buyers, this could actually be the opportunity you've been waiting for? Stick around, because I am going to break down exactly how rising rates can work in your favor and give you a huge advantage. First, let's get one thing straight. Yes, a higher interest rate means a higher monthly payment. We can't ignore that. But it's not the whole story. What happens when rates go up? The buying frenzy slows down. Remember those insane bidding wars from a year or two ago? Homes selling for tens, even hundreds of thousands over asking, with waived inspections. That's the first thing to disappear. Higher rates push a lot of casual or less prepared buyers to the sidelines. This means less competition for you. Imagine being able to make an offer on a house without having to fight off 20 other buyers. That's a massive win. You get your power back as a buyer. With less competition, sellers start to get a little nervous. The name your price mentality evaporates. Suddenly, they're more open to negotiation. You can actually offer the asking price, or even slightly below, and have a real chance of getting it accepted. We're also seeing the return of contingencies. Remember those? Things like a home inspection contingency, a financing contingency, or even a home sale contingency. These are your safety nets. In a hot market, buyers were forced to waive these just to compete. Now, you can protect yourself by making your offer conditional on a satisfactory inspection. That's a level of security that was almost impossible to find just a short while ago. Let's talk about the inventory. As the market cools, homes tend to stay listed for longer. Instead of a property being snapped up in a weekend, it might sit for a few weeks or even a month. What does this mean for you? More time. You have time to actually think about the biggest purchase of your life. You can visit a property multiple times, compare it with other options, and make a decision without feeling immense pressure. This also leads to a buildup of inventory. You're not just scrambling to buy the one and only decent house that popped up this week. You can be more selective and find a home that truly fits your needs, not just one you settled for out of desperation. Now, let's address the elephant in the room, the higher monthly payment. It's a real factor, but there's a strategy here. The saying in real estate is, marry the house, date the rate. You buy the house for the long term. When rates drop in a year or two, you refinance to a lower payment, and you've won on both ends. A great price and a great rate. It all comes down to preparation. First, get your finances in rock-solid shape. Your credit score is more important than ever. A higher score can qualify you for a better interest rate, even in a higher-ed environment. Save aggressively for a down payment. Second, get pre-approved for a mortgage, not just pre-qualified. A pre-approval means a lender has thoroughly reviewed your finances and is committed to lending you a specific amount. They can help you craft an offer that is both attractive to the seller and protective of your interests. Ask them about days on market, price reductions in the area, and seller concessions. This data is your ammunition in a negotiation. This is another perk of a cooler market. What are they? It's when the seller agrees to pay for some of your closing costs. You can even use concessions to buy down your interest rate, where the seller pays a fee to the lender to give you a lower rate for the first few years of your loan. It's a creative way to make your monthly payment more manageable in the short term. So let's recap the opportunity. Rising rates weed out the competition, giving you more negotiating power. Sellers become more realistic and more willing to make a deal. You get the return of crucial buyer protections like inspection contingencies. Inventory builds up, giving you more choices and more time to make a decision. And while the rate might be higher today, you're securing a better purchase price on the asset itself, with the plan to refinance that rate in the future. You are trading a temporary high rate for a permanent better price. That's the winning formula. The key is to be patient, be prepared, and be strategic. Don't let the scary headlines deter you. Look at the real dynamics of the market. And for those who have their ducks in a row, it's a golden opportunity. We've spent a lot of time talking about mortgages dissecting interest rates, down payments, getting approved, and what those monthly payments look like. But I need to be real with you for a second. Getting a mortgage, that's not the finish line. In fact, it's not even the main event. A mortgage is just a tool, a very powerful one, but still just a tool. The most important question isn't how do I get a loan? The real question you should be asking is, what am I going to do with this loan once I get it? And that, my friends, is where the world of real estate investing truly opens up. So, let's shift gears. It's time to explore how savvy people use mortgages not just to buy a place to live, but to actively build serious wealth. Let's get into it. Ever wondered how real estate investors seem to print money? It's not magic, I promise. Today, we're pulling back the curtain on the 4 main ways real estate investing can build serious wealth. Forget the get-rich-quick hype. This is the real deal. First up, the most straightforward method, cash flow. Think of it like this. You buy a property, you rent it out. Your tenant pays you rent every month. From that rent, you pay all your expenses, your mortgage payment, property taxes, insurance, maintenance, maybe a property manager's fee. Whatever is left over at the end of the month is your cash flow. It's pure profit that lands in your bank account. Next, let's talk about appreciation. This is the one most people think of when they imagine real estate riches. Appreciation is simply the increase in your property's value over time. There are 2 types. The first is natural or market appreciation. This happens when the area around your property improves. Maybe new jobs are coming to town, a new school is built, or the city just becomes a more desirable place to live. As demand goes up, so do property values. You don't have to do anything but own the property in the right place at the right time. The second type is forced appreciation. This is where you, the investor, take control. You buy a property that's a little dated or needs some work, and you improve it. You renovate the kitchen, update the bathrooms, add a deck, or finish the basement. By making these strategic upgrades, you force the value of the property to go up, often by more than what you spent on the renovations. It's a powerful way to actively build equity instead of just waiting for the market to do the work for you. The third moneymaker is the mortgage loan paydown. This is one of the most underrated but incredibly powerful aspects of owning rental real estate. Every single month, when your tenant pays your rent, you use a portion of that money to make your mortgage payment. A part of that payment goes toward interest. But a significant chunk goes toward paying down the principal, the original amount you borrowed. So, with every payment, you own a little bit more of the property. Your tenant is literally buying the asset for you over time. Imagine fast-forwarding 15 or 30 years. The mortgage is completely paid off, and you own this valuable asset free and clear. That entire property value is now part of your net worth, all thanks to your tenants' monthly rent checks. It's a slow and steady wealth-building machine that works quietly in the background. Finally, we have the incredible tax benefits. Now, I'm not a tax advisor, so always consult with a professional. But the tax advantages of owning real estate are a huge reason why so many wealthy people invest in it. The government actually incentivizes you to provide housing. One of the biggest benefits is depreciation. You can deduct a portion of your property's value from your rental income each year, which can significantly lower your taxable income. It's a phantom expense because you're not actually spending that money, but you get to claim it as a loss. You can also deduct all your operating expenses. You can use something called a 1031 exchange to defer paying capital gains taxes by rolling your profits into a new investment property. These tax strategies allow you to keep more of your money working for you, accelerating your wealth-building journey. So let's put it all together. A single-family home or a small multifamily property can be a fantastic way to get your feet wet. The important thing is to take that first step. The power of leverage is another concept you have to understand. In real estate, you can use other people's money, mainly the banks, to buy an asset. You might put down 20% to buy a property, but you get 100% of the benefits, all the cash flow, all the appreciation, all the loan paydown. If that $300,000 property you put $60,000 down on goes up in value by $15,000, your return on your cash invested isn't 5%, it's 25%. That's the magic of leverage. It amplifies your returns and allows you to grow your portfolio much faster than if you had to pay all cash for every property. Of course, leverage also amplifies risk, which is why it's so important to buy right and have cash reserves for unexpected expenses. Don't over-leverage yourself. Be smart and strategic. So, to recap, real estate investors make money through cash flow from rent, appreciation in property value, tenants paying down the mortgage, and significant tax benefits. When you combine all four of these, you create a powerful engine for building long-term wealth. It's not a get-rich-quick scheme. It's a get-rich-for-sure plan if you're patient, disciplined, and willing to learn. It's about building a portfolio of assets that work for you, so one day, you won't have to. I hope this breakdown has demystified how real estate investing works. It's a tangible, proven path to financial freedom that's accessible to more people than you might think. Now, we're diving into one of the biggest debates in real estate investing: rental income versus appreciation. Which one should you focus on? Which one actually builds wealth faster? Let's break it down. Imagine you're at a crossroads. One path leads to a steady stream of cash every month, like a reliable paycheck. The other path leads to a pot of gold at the end of a long journey. This is the core of the cash flow versus appreciation dilemma. First, let's talk about rental income, or cash flow. This is the money you have left over each month after you VA paid all the expenses on your property mortgage, taxes, insurance, repairs, you name it. A property with positive cash flow is essentially paying for itself and putting extra money in your pocket every single month. Why is this so powerful? Well, for starters, it provides financial stability. That monthly income can cover your living expenses, help you save for another down payment, or just give you peace of mind. It's tangible, predictable, and reduces your risk. If the market takes a dip, you're not forced to sell because you can still cover your costs with the rent you're recollecting. This is the strategy that many people use to achieve financial independence and even quit their 9-to-5 jobs. they build a portfolio of properties that generates enough passive income to cover their lifestyle. The main benefit here is immediate returns and reduced risk. You're not just hoping the property value goes up, you're making money from day one. This strategy is often favored by more conservative investors or those who need a consistent income stream. It's about building a solid, defensive financial foundation. Now let's flip the coin and look at appreciation. Appreciation is the increase in your property's value over time. You buy a house for $300,000, and 10 years later, it's worth $500,000. That $200,000 increase is your appreciation. This is where you hear stories of people becoming millionaires through real estate. Appreciation is all about long-term wealth creation. It's not about the small monthly wins. It's about the massive jump in your net worth over years or even decades. The power of appreciation is amplified by leverage. You don't have to pay for the entire property in cash. You might put down 20%. So on that $300,000 house, your initial investment is $60,000. If the house appreciates to $500,000, your $60,000 investment has helped you gain $200,000 in equity. That's a phenomenal return. Investors who focus on appreciation often buy in high-growth areas. Think booming cities with strong job markets and population growth. These properties might not have great cash flow. In fact, they might even be negative cash flow, meaning you have to pay a little out of your own pocket each month to cover expenses. The bet is that the long-term appreciation will far outweigh these small monthly losses. This is a more aggressive strategy, often suited for investors with a higher risk tolerance and a stable primary income to cover any shortfalls. So, we have cash flow for stability and immediate income, and appreciation for massive, long-term wealth growth. Which one is better? Well, here's the secret. You don't have to choose. The best investors don't ask which one. They ask, how can I get both? The ideal investment property, the holy grail of real estate, is one that provides positive cash flow from the start and is located in an area with strong potential for appreciation. This is the win-win scenario. You get paid to wait for your property to increase in value. Let's walk through how to find a property like this. You start by looking for markets that have solid economic fundamentals. Are companies moving in? Is the population growing? Are there new developments happening? These are all signs of a market that's poised for appreciation. But you don't stop there. Within that strong market, you need to drill down to the neighborhood and property level to run your numbers. This is where the cash flow analysis comes in. You need to accurately estimate your rental income and all your potential expenses. A common rule of thumb is the 50% rule, which suggests that about half of your rental income will go towards operating expenses, not including the mortgage. So, if a property rents for $2,000 a month, you can estimate that $1,000 will go to things like taxes, insurance, maintenance, and property management. Then, you see if the remaining $1,000 can cover your monthly mortgage payment. If there's money left over, you have positive cash flow. Finding a property that meets both criteria can be challenging, especially in hot markets where prices are high. It requires patience, research, and a willingness to look where others might not be looking. Maybe it's a slightly older property that needs a little cosmetic work. Or perhaps it's in an up-and-coming neighborhood that isn't on everyone's radar yet. Your personal financial situation also plays a huge role. If you're nearing retirement and need a stable income source, a portfolio of high cash-flowing properties in a steady, mature market might be your best bet. On the other hand, if you're young, have a secure job, and a long-time horizon, you might be more willing to take a risk on a negative cash flow property in a high appreciation market. Let's consider a hybrid strategy. You could start by acquiring a few cash-flowing properties to build a stable income base. This passive income can then be used to fund a more appreciation-focused investment. Your cash flow properties act as your financial safety net, allowing you to take calculated risks on properties with higher growth potential. Ultimately, the debate isn't about choosing one over the other. It's about understanding how both rental income and appreciation contribute to building wealth and designing a strategy that aligns with your personal goals, timeline, and risk tolerance. The smartest investors know that cash flow pays the bills, while appreciation builds the fortune. By aiming for both, you create a resilient and powerful real estate portfolio that can weather any storm and set you on the path to true financial freedom. A lot of people think buying a property is just about having a place to live, but it's so much more than that. It's one of the most reliable and powerful engines for creating financial freedom. But how exactly does it work? Well, it all boils down to two key concepts: cash flow and equity. Understanding how these two forces work together is the secret sauce to becoming a successful real estate investor. So, if you've ever dreamed of building a portfolio that generates income and grows in value, you're in the right place. Stick around, because by the end of this video, you'll have a crystal clear roadmap on how to use real estate to build lasting wealth. Let's start with cash flow. In the simplest terms, cash flow is the money left in your pocket after all the bills are paid. Imagine you own a rental property. Each month, your tenant pays you rent. From that rental income, you have to pay your expenses: the mortgage payment, property taxes, insurance, maybe a fee for a property manager. And you should always set aside some money for maintenance and repairs. Things will break, and you need to be prepared. What's left over after you've paid all of those costs? That's your net cash flow. It's the profit you make every single month, just for owning the property. It's a beautiful thing, isn't it? This is what we call passive income. It's money that comes in whether you're working, sleeping, or on vacation. The goal for many investors is to acquire enough properties with positive cash flow to cover all of their personal living expenses. When your passive income from real estate is greater than your expenses, you've achieved financial independence. You're no longer trading your time for money. That's the power of cash flow. So, how do you find a property that actually generates positive cash flow? It's not as simple as just buying any house and renting it out. You need to do your homework. This is where a lot of new investors make mistakes. The key is in the numbers. You need to analyze the deal before you ever make an offer. First, research the market to understand the average rent for the type of property you're looking at in that specific area. Websites like Zillow or Rentometer can give you a good starting point. Next, you need to accurately estimate all your potential expenses. The mortgage is the easy part, but don't forget the pity: principal, interest, taxes, and insurance. Then, add in your other costs. A good rule of thumb is the 50% rule. It suggests that about 50% of your gross rental income will go towards expenses, not including the mortgage payment. This covers things like vacancies, repairs, property management, and other operational costs. So, if a property rents for $2,000 a month, you'd estimate that $1,000 will go to operating expenses. Then, you subtract your mortgage payment from the remaining $1,000 to see your potential cash flow. It's a conservative estimate, but it helps you quickly analyze if a deal is worth a deeper look. Running the numbers is the most critical step. Don't let emotions guide your purchase. Let the math do the talking. A good cash-flowing property is your foundation for building a solid real estate portfolio. Now, let's talk about the second wealth builder: equity. If cash flow is the monthly paycheck from your property, equity is your long-term savings account, and it grows in some really powerful ways. Equity is simply the difference between what your property is worth and how much you owe on it. For example, if you buy a house for $300,000 and you put down $60,000, you have $60,000 in equity from day one. The remaining $240,000 is your mortgage loan. But here's where the magic happens. Equity doesn't just sit there, it grows. There are two primary ways your equity increases. The first is through loan paydown. Every single month, when you or your tenant makes that mortgage payment, a portion of it goes towards paying down the principal of the loan. In the early years of a mortgage, most of the payment goes to interest, but a small amount still chips away at that principal balance. As time goes on, more and more of your payment goes towards the principal. So, month after month, year after year, you are systematically paying down your debt and increasing your ownership stake in the property. You are building wealth automatically with every payment. This is called amortization. You're essentially forcing yourself to save and build wealth over time. The second, and often more dramatic, way equity grows is through appreciation. This is the increase in your property's market value over time. Real estate has historically been an asset that appreciates. While there are market fluctuations, over the long term, property values tend to go up due to factors like inflation, population growth, and development in the area. Let's go back to our $300,000 house. Imagine that over 5 years, thanks to a growing local economy and increased demand, the house is now worth $380,000. That's $80,000 in appreciation. Your equity has grown not just from paying down the loan, but from the market itself doing the heavy lifting. This is where real estate truly shines as an investment. You're not just getting cash flow, you're also benefiting from the growth in the underlying asset's value. You can't get that from just saving money in a bank account. So now we have these two powerful forces: cash flow and equity. How do they work together to make you rich? Think of it like a 1-2 punch for wealth creation. Your cash flow provides the immediate income. It pays the bills, gives you financial breathing room, and funds your lifestyle. It's the engine that keeps your investment machine running smoothly. But equity is your long-term wealth accelerator. As your equity grows, your net worth skyrockets. And here's the best part. You can use that equity. You don't have to sell the property to access it. You can do what's called a cash-out refinance or get a home equity line of credit, also known as a HELOC. This allows you to pull out a portion of your equity in cash, tax-free, which you can then use to buy another property. Let me walk you through an example. You buy your first rental property. For a few years, You collect the cash flow, and your tenants pay down your mortgage while the property appreciates in value. Now you have a good chunk of equity built up. You go to the bank, do a cash-out refinance, and pull out that equity. Now you have a down payment for your second rental property. And guess what? The second property starts generating its own cash flow and building its own equity. You repeat the process. You use the equity from your first two properties to buy a third, and then a fourth, and so on. This is how real estate investors scale their portfolios and build massive wealth. It's a strategy often called the BRRRR method. Buy, rehab, rent, refinance, repeat. You're using the wealth created by one property to finance the acquisition of the next. Your portfolio starts to snowball, with each new property adding to your cash flow and your equity growth. This is how you can go from one property to a multi-million-dollar portfolio in a matter of years, all starting with that first smart investment. So which one should you focus on? Cash flow or equity? This is a common question, and the answer really depends on your personal financial goals and your stage in life. If you're young and looking to build a foundation for long-term wealth, you might focus more on appreciation and equity growth. You could invest in a high-growth area where property values are expected to rise significantly, even if the monthly cash flow is minimal or just breaks even. Your strategy here is to hold for the long term and let appreciation do its work. On the other hand, if you're closer to retirement or you want to quit your job sooner rather than later, cash flow is king. Your primary goal is to replace your active income with passive income. You'd look for properties in stable markets that produce strong, reliable monthly cash flow, even if the appreciation potential isn't as dramatic. These are often found in more affordable markets in the Midwest or the South. But here's the secret. The most successful investors don't choose one or the other. They look for properties that offer a healthy balance of both. The ideal investment property provides you with positive cash flow from day one, covering all its expenses and putting money in your pocket, while also being located in an area with solid long-term growth prospects for appreciation. Finding these deals takes more work, more research, and more patience, but they are the holy grail of real estate investing. They allow you to enjoy income today while building massive wealth for tomorrow. It's about creating a balanced portfolio. Some properties might be cash flow cows, while others might be equity powerhouses. By combining both strategies, you create a resilient and highly profitable real estate business that can weather any market condition and carry you to financial freedom. In conclusion, real estate offers a proven two-pronged approach to building generational wealth. Cash flow is your income engine, providing you with passive income month after month, giving you financial stability and freedom. Equity is your wealth multiplier, growing quietly in the background through loan paydown and appreciation, building your net worth and providing the capital to expand your portfolio. By understanding and harnessing the power of both, you can turn a single property into a real estate empire. It's not a get-rich-quick scheme. It requires education, patience, and smart decision-making, but the path is there for anyone willing to learn it and take action. Start by educating yourself, learning how to analyze deals, and then take that first step. Things are changing fast, and if you want to stay ahead of the curve, you need to know what's coming. We're not just talking about next year. We're looking at the big shifts that will define real estate for the next decade. So, what are the smartest investors doing right now to prepare? Let's break it down. First up, let's talk about the demographic earthquake that's happening. Millennials are now the largest generation in the US, and they're finally entering their peak home buying years. But what they want in a home is totally different from previous generations. They're looking for flexible spaces that can double as home offices. They value walkability and proximity to amenities, and they're incredibly tech-savvy. This means properties with smart home features, high-speed internet, and energy-efficient systems are no longer just a bonus. They're becoming a baseline expectation. Smart investors are already retrofitting older properties or focusing new developments on these features to attract this massive demographic. At the same time, we have the baby boomers. This generation is downsizing, but they're not just moving into quiet retirement communities. Many want to age in place or move to smaller, low-maintenance homes in vibrant, amenity-rich areas. This is creating a huge demand for single-story homes. Condos with universal design features like wider doorways and walk-in showers, and properties in what are called suburban areas, suburban neighborhoods, with urban-style walkability. Investors who can cater to both of these massive generations, the millennials and the boomers, are setting themselves up for a dual-engine growth machine. Now, let's zoom in on technology, because it's completely rewriting the rules of the game. The rise of remote work is probably the single biggest disruptor we've seen in decades. It is untethering people from expensive coastal cities and allowing them to move to more affordable markets in the Sun Belt and the Midwest. We're seeing a migration pattern that's creating boomtowns in places like Austin, Boise, and Nashville. Smart investors are following the remote jobs. They're reanalyzing data on which cities are attracting the most remote workers and investing there before prices skyrocket. It's not about where the big corporate headquarters are anymore. It's about where people want to live. This ties into the work from anywhere economy. It's not just about a home office anymore. People now want a Zoom room, a quiet and professional-looking space for video calls. They want homes with great natural light, and maybe even a nice backyard or patio for a change of scenery. This is a fundamental shift in how we value our living spaces. A home is no longer just a place to sleep. It's our office, our gym, our entertainment center. Properties that offer this all-in-one lifestyle are commanding a premium. Investors who understand this are focusing on properties that offer more than just four walls and a roof. They're selling a lifestyle. And we can't talk about the future without mentioning sustainability and climate change. This is becoming a major factor in real estate valuation. Properties in areas prone to wildfires, floods, or hurricanes are facing rising insurance costs and declining buyer interests. On the flip side, green homes are more in demand than ever. Homes with solar panels, energy-efficient appliances, and sustainable building materials are not only better for the planet, but they also offer lower utility bills, which is a huge selling point for buyers. Investors are now conducting climate risk assessments on potential properties. They're looking for locations that are resilient and investing in green retrofits to future-proof their portfolios and attract environmentally conscious tenants and buyers. Let's pivot to affordability, which remains the elephant in the room. With interest rates fluctuating and home prices still high in many areas, the dream of homeownership feels out of reach for many. This is creating a huge, permanent class of renters. So, what does this mean for investors? It means the rental market, especially for single-family homes, is going to remain incredibly strong. Build-to-rent communities are one of the hottest sectors in real estate right now. These are entire neighborhoods of single-family homes built specifically for long-term rental. They offer the space and privacy of a house with the professional management and amenities of an apartment complex. It's the best of both worlds for many families. Another solution to the affordability crisis is the rise of co-living and alternative housing models. Think smaller, more efficient units, accessory dwelling units, or ADUs also known as granny flats, and even modernized manufactured homes. Zoning laws are changing across the country to allow for more density and smaller housing types. Investors who are creative and willing to explore these non-traditional housing solutions can tap into a massive, underserved market. It's about providing attainable housing options where they are needed most, which can be both a profitable and socially impactful strategy. So, how do you put all of this together? The future-focused investor is a data-driven strategist. They aren't just looking at last year's sales comps. They are analyzing demographic trends, migration patterns, technological adoption rates, and climate risk data. They are using AI and predictive analytics to identify emerging hotspots before they hit the mainstream. They're looking at job growth, quality of life metrics, and local government policies on development. They understand that the old playbook of location is being updated. Now, it's location, connection, and resilience. Let's recap the key strategies. 1. Target demographics. Understand the unique needs of millennials and baby boomers. 2. Embrace technology and the remote work revolution. Follow the talent to emerging lifestyle cities. 3. Prioritize sustainability. Invest in green features and climate-resilient locations. 4. Address affordability. Explore the massive potential of the single-family rental market and alternative housing solutions. And 5. Be data-driven. Use modern tools to make informed decisions instead of relying on gut feelings. The U.S. real estate market is definitely navigating a period of profound change, but with change comes incredible opportunity. The investors who will thrive in the coming years are the ones who are preparing today. They are adaptable, forward-thinking, and they see the big picture. They understand that real estate isn't just about brick and mortar anymore. It's about demographics, technology, and lifestyle. By focusing on these key trends, you can position your portfolio not just to survive the shifts ahead, but to truly prosper. Now, let's talk about the future of the U.S. real estate market. Things are shifting, and if you want to stay ahead of the curve, you need to know what's coming. So, what are the smart investors preparing for right now? Let's break it down. First, let's talk about the elephant in the room: interest rates. We've seen some big swings, and that's not going to stop. Smart investors aren't trying to time the market perfectly, because that's nearly impossible. Instead, they're stress testing their portfolios. They're asking, can my investments still cash flow if rates go up another half a point, or even a full point? They're building bigger cash reserves and focusing on deals that have strong fundamentals from day one. not just deals that look good with today's rates. The key takeaway here is to be conservative with your numbers and prepare for volatility. Don't over-leverage. A property that bleeds cash when rates tick up is a liability, not an asset. Next up, demographics. This is a huge, often overlooked driver of real estate trends. The millennial generation is now the largest home buying cohort, and their preferences are shaping the market. They're looking for affordability, flexibility, and often, proximity to urban centers or vibrant suburban communities. But don't forget about the baby boomers. As they retire, many are downsizing or moving to warmer climates. This creates opportunities in specific markets, particularly in the Sun Belt. Smart investors are analyzing these demographic shifts. They're not just looking at a city's overall growth. They're looking at who is moving there and what kind of housing they need. Is it starter homes for young families? Is it luxury condos for downsizing boomers? Or is it rental properties in areas with strong job growth for Gen Z? Following the people is always a winning strategy. Let's pivot to technology and its impact, because it's massive. The rise of remote work has completely changed the game. Before, proximity to a specific office was a primary driver of value. Now, for millions of Americans, it's about proximity to a good lifestyle. This has fueled the growth of so-called Zoom towns, smaller, more affordable cities with great amenities. Investors are taking note and looking at these secondary and tertiary markets that were once overlooked. They're seeking places with high-speed internet, good schools, outdoor recreation, and a strong sense of community. The 9-to-5 commute is no longer a given, and your investment strategy needs to reflect that new reality. Another tech-driven trend is the rise of PropTech, or property technology. This includes everything from smart home features that attract tenants to sophisticated software that helps you manage your properties more efficiently. Smart investors are leveraging technology to gain an edge. They're using data analytics to identify undervalued markets, virtual tours software to lease units faster, and property management platforms to streamline operations and improve the tenant experience. In today's market, being tech-savvy isn't just a bonus. It's essential for maximizing returns and minimizing headaches. If you're still managing everything with a spreadsheet and a flip phone, it's time for an upgrade. Now, let's talk about affordability, because it's a major challenge. Home prices and rents have outpaced wage growth in many parts of the country. This creates both a problem and an opportunity. The opportunity lies in providing affordable housing solutions. This doesn't just mean low-income housing. It can mean investing in Class B or C multifamily properties and improving them. It can mean exploring innovative models like co-living or building smaller, more efficient single-family homes. The demand for housing that regular people can actually afford is immense and isn't going away. Investors who can figure out how to serve this segment of the market will not only do well financially, but will also be providing a valuable social good. Another area savvy investors are watching closely is the changing landscape of commercial real estate. The pandemic hit office and retail spaces hard. And while some of that is bouncing back, the world has changed. There's a flight to quality, where newer amenity-rich office buildings are doing well, while older, less desirable ones are struggling. Some investors are looking at opportunities to convert these underperforming office buildings into residential units, a complex but potentially very profitable play. Similarly, in retail, well-located centers anchored by grocery stores and essential services are thriving, while traditional, enclosed malls face an uphill battle. It's about understanding which subsectors have long-term viability and which are facing permanent structural decline. Let's also touch on sustainability and ESG, environmental, social, and governance factors. This is no longer a niche concern. Tenants and buyers, especially younger ones, increasingly prefer properties that are energy efficient and environmentally friendly. This can mean solar panels, better insulation, water-saving fixtures, and EV charging stations. These features can not only attract higher quality tenants and buyers, but can also lower your operating costs over the long term. Smart investors are incorporating green upgrades into their renovation plans, recognizing that it's good for the planet and good for their bottom line. It's a true win-win. So, to wrap it all up, what are the key takeaways for the future? First, prepare for interest rate uncertainty by being conservative and maintaining strong cash reserves. Second, follow the demographic trends. Know where the millennials, Gen Z, and boomers are moving and what they want. Third, embrace technology, from recognizing the impact of remote work to using PropTech to manage your assets. Fourth, focus on the affordability crisis and look for ways to provide housing solutions for the middle market. Fifth, be selective with commercial real estate, understanding the massive shifts in office and retail. And finally, think green. Sustainable investing is the future. The U.S. real estate market is complex and always evolving, but it's not unpredictable. By paying attention to these major trends, you can position yourself not just to survive, but to thrive in the years to come. It's about being proactive, not reactive. It's about making smart, data-driven decisions instead of just following the herd. Thanks so much for watching today. I hope this gave you some valuable insights to think about for your own investment journey. If you found this helpful, please hit that like button and subscribe for more content on real estate and investing. Let me know in the comments which of these trends you think will have the biggest impact.